When I first discovered the stock market, it was love at first sight. It became my dream to be a professional trader. I scraped together enough money for a small account to get me started. You can see that balance here. That account balance, though, however, is pretty small, and it's not going to be enough to help me make it as a professional trader. It's going to have to get a lot bigger. The question is, how much bigger? Well, to answer that, we need to answer the question of how much money I need to make. Given the fact that minimum wage is $15 an hour, and 52, if you worked a year at minimum wage, that would give you $31,200 a year. Okay, well, as a trader, that means you have 252 trading days a year, and 252 trading days a year divided by, or 31,200 divided by 252 trading days a year, gives you need to make about $125 a day. I'm writing about this journey and I'm talking about it here in the Russell Journal. My name is Russell, and this is my journal entry for today, October 7th, 2022. Okay, coming into today, one of the things that's big on the news is we have elections coming. Elections are big. It has an effect on the market. However, if you've read much of the literature around the stock market, you will know that if you've read much of the literature around the stock market, you will know overall politics doesn't actually have that big of an effect on the market movements on a day-to-day. There's been studies done on this that show almost no correlation. However, there are some things that do affect it. And so what you're seeing here today in all of this green is everybody's kind of looking through the market going, well, these are the companies that will be good if the Democrats win. These are the companies that will be good if the Republicans win. And those companies make up all of these sectors. Okay? So where you have is what you have is that, like, you know, for a Republican Congress is going to overall long-term be good for energy. Okay? Things of that nature. Whereas Democratic Congress is going to be good for green energy, things of that nature. So you really have to sort of break it down as to what you think each politician, each political party will do. And what happens then is you get a lot of money that comes into the market ahead of that election, hoping for their side or whoever they think is going to. Maybe it is their side, maybe it's not. Maybe they're just like, well, I think the Democrat's going to win, even if I'm a Republican. That means I'm going to buy Tesla and, you know, electric car companies. Or maybe that means you're going to, if the Republicans are going to win, well, we're going to buy oil, Marathon Oil, and things of that nature. So you get this really interesting mix of a rally coming in. And one of the things I want to encourage people to do when you step into the stock market, take off your tinfoil hat, okay? Markets are, yes, they're manipulated. And to be honest with you, we're counting on that. We're hoping it's manipulated. We're going to make money based on that manipulation. We're just hoping to figure out which side of the manipulation that we're picking the right side of that manipulation, okay? That's really, this whole concept of like manipulation being bad, we want, the minute you buy something in the stock market, you're manipulating the stock market. The minute you sell, you're manipulating something in the stock market. You're either helping the price to go up or helping the price to go down. So it doesn't really matter whether it's you or Goldman Sachs or anybody else, right? For whatever reason you are buying and you are manipulating. And if you are a trader, you are just hoping to be on the right side of that manipulation, okay? So going into the election, you get these massive rallies up. And there's reasons why, okay? Now, the thing that the stock market loves the most, okay? And then we saw this back in 2020. We can go back and see it in other times. On the chart, you can see it there. What the market loves is a gridlocked government, okay? What you want to think is like, if you're a Republican, well, if we the Republicans get in, we're going to make things good. The market's going to be good, right? If you're a Democrat, you're thinking, oh, they're going to fix the country and the social problems, and the market's going to be good, right? And so, but the thing is like, no, the market doesn't like any of that, right? Most of this stuff that is here doesn't run on basic business sense. It's not a question of, well, it's so frustrating, okay? It's so frustrating. The capitalism model and where it starts to break down from almost industrialism to investment, I don't know, investmentism or investing, like I don't know what the word would be for it, but here's the deal. These are all used to defend against two things. They defend against inflation and they defend against taxes, okay? Guys keep their money parked in here and use it sparingly, the money they have parked in here, to increase the value of their wealth, right? How much these guys are worth, and then they borrow against it, okay? Nobody, any people coming in to buy this stuff aren't like regular traders. They're not coming in here to buy this in order so that they can sell it and then go spend that extra money they made in equity. They want to keep their money parked here for two reasons. Either A, it's beating inflation, right? It's giving them a return that's higher than the rate of inflation, which right now it's not. It's not. But the other thing that they do with it is they park it here and leave it here because it represents unrealized gains. And unrealized gains until now are not taxed. So they can grow their wealth tax-free in this stuff. And that's the big money. That's what they're doing. That's what they're concerned about. That is the defensive, right? The difference here, if you are not overly affluent, rich, wealthy, if you're not making more than $200,000 or $400,000 a year, you are considered not affluent, okay? Let's draw lines. Call it 150,000, okay? You're not making more than 150,000 a year. You're upper middle class. You're not affluent, okay? You might be comfortable, whatever, but you're not considered affluent, all right? So the thing is in your mind, you're trying to figure out how to get rich, right? But if you have millions of dollars in here, you're not trying to figure out how to get rich. You're trying to figure out how to stay rich. There's two different sort of angles to this. And that's where the election does have some matter. And when you have a gridlock Congress or a gridlock government, they can't raise taxes. Sure, they can't lower taxes, but things are stable. And as long as things are stable, you're free to make decisions here. What to buy, what to sell, right? You know the costs. But if you go from having a really liberal Congress to having a really Republican Congress back to a really liberal, right? If it's swinging both ways, you don't know what to do, right? Especially if your investment horizon is the next 20 years. That's 10 elections, midterms and regular term elections. So how do you make decisions about investing over the next 20 years if the Congress just keeps going like this, right? You don't know. You can't do it. So the thing is like, the stock market loves a gridlock Congress. They're hoping for that because it means whatever we have now is stable and it's the devil you got is better than the devil you know, okay? And so they run on that, okay? And you will see. Remember last time when Biden got into office and the Republicans held one majority over here and the Democrats held one majority over here, and everybody's, oh no, it's bad, we have a Democratic president, but you still got an overall gridlock Congress. You can't really do much, right? And especially with that Joe Manchin guy in there. So you have plenty of your difficulties, right? You have plenty of your issues in all of that. So, but at the same time, market still ran up, right? Still ran up on a Democratic president being elected. We had a rally, right? So is that going to happen again? And this is where we go, it depends. Chances are, if you come into a place where if you keep the Congress gridlocked, if you keep the government gridlocked, probably going to have a rally. And you'll have a rally for a couple of reasons. One, again, Republicans or people who, right, next year, the Democrats passed a bill that companies doing stock buybacks have to pay 1% tax on those stock buybacks. That starts next year, on the other side of January. So what's better for them to do? Sit on top of their cash, maybe do their stock buyback next year and pay the 1%? Well, we just discussed that the market likes the devil it knows, preferably to the one it doesn't. So what happens? Well, they're going to do their stock buybacks this year. And they're going to do it as much as they possibly can, right? So that's going to go into this. Now, again, if you get a Republican Congress, maybe things change a little bit. But for the most part, they're going to make decisions based on the devil they know, which is 1% taxes, right? So at the same time, Republicans get in. Energy for American energy is going to do really well. They're going to work very hard, especially the fossil fuel sector. Now, I'm not saying fossil fuels are good or bad. I'm not saying go green energy, anything like that. I'm just a trader. No real opinion. If I did have an opinion, it would be for nuclear. That's about it. Anyway, so going into tomorrow's election day, right? What do you think is going to happen? Well, you're probably going to get more of what you had today. Another rally, more continued rally. And then coming into Wednesday, so it depends. So everything really, really depends on what happens tomorrow. Now, tomorrow is Tuesday, and even though we're getting into Election Day there, it's typically referred to as Turnaround Tuesday. Okay, we will talk about this in a little bit. Let's go to the chart. Let's talk about what happened today, what we did. I will explain to you some of the stuff that happened in with these positions over here. We're doing really, really awesome in both of those. That was actually pretty cool. We have the SPY chart right here. And as you can see, this chart is very, very noisy. So I apologize right now for it. Where we are right now on this chart behind me is this is the 30-minute time frame of SPY. That's the cash equivalent of the S&P 500. If you're not trading strictly futures contracts, you want to buy the S&P 500 with cash, you're going to buy SPY. There's a bunch of other ones that are the same. There's VOO and stuff like that. That doesn't really matter because we're trading SPY. We trade on SPY. All right. So what you can see here, so there's a few things I want you to notice. The very first thing I want you to notice is this trend line I drew right here. Okay. Now, the reason this is important is because this trend line goes all the way back to the last CPI report, where we had that massive rally from $348 and we just skyrocketed into FOMC before you got this big nasty sell-off, okay? Now, one of the things that's very interesting about this, the reason we put this trend line here is because I want you to see that this move up here, right here, this whole move throughout here is trying to get back into that trend line. It wants to test that trend line, okay? Now, I put a line up here as to where I think it will come into contact if we continue, if the momentum stays good, where it will come into contact with that, right? So right now, I would say the risk is to the downside in this market mostly, especially going into CPI. I think there's a lot of stuff. We've seen some tiny cracks, and we're really hoping that as we begin to see more of the economic weakening, that will begin to be the end of inflation, okay? Now, there's some wobble in here between the end of inflation, the earnings compression that we're going to see, right? This does not mean that it's going to go straight to the moon. We're going all the way back to all-time highs. It just means that things are okay enough for some people to come in and start putting some money into these indexes and into these ETFs. And there's some things also on the horizon that even though earnings may be bad in one place, they could be better in another. Example, we discussed yesterday, we discussed China. China could be doing very, very, if they come back online, if they give up their zero COVID policy, there's a pretty good chance that a lot of those commodities will go through the roof because those guys are going to be using that stuff in the event that their manufacturing comes online, their home building goes back online, everything starts working again over there. That's 1.3 billion people. They will be using that much more commodities more regularly once that thing comes on, and that's gonna have an effect over here, right? That's gonna make this sustain some of its value or even gain some value. So we have some things that are valuable, and the value of an index is the fact that you have the good and bad mixed in together. And when things are good, they can help everything up, and when things are bad, the good things can keep it from being as bad, right? So that's a huge punch of the value. So we're thinking about this and stuff. Now, as regards to the China thing, China did come out. They released a statement saying, no, we are not getting away from our zero COVID policy. They will. Eventually, they will quit because they will start to be starving or hungry, or they'll have some type of revelation. Okay, as far as my trade went today, I was really watching this. I was watching these two sort of boxes here that I put on the screen. Just so you know, this vertical is left of that, or out this way, basically. I'm not sure which it is on your screen. That will be today's price action. And you can see I basically put these boxes in here. We had this sort of sideways action into the morning. I sat back and waited most of the day. And as this continued to build support, I took on a long position here. But I really wasn't confident in it. So I went over here and I added a put position. It expired today. And we logged in. The call profited over $100. It was very good, very happy. But we did lose the premium from the put side. And what we gained today was about $44 or $54 in today's stuff. Not quite my $125 price target, the goal that I need to make. But as I said in the beginning, the $400 is not enough to generate $125 a day. If it was, we'd all be rich. I swear everybody would be a wealthy person, and it would be that easy, you know. So we are going to continue to build it up. Second thing is, you can see in the move up, our call that we've been holding, that one side of our straddle that is paid for, even though it's red. We have that money is back in our account. We are safe, okay, because we made money on the put side. We rode this big bad baby all the way down, which was very nice. It was a good win. Anyway, so the call's paid for, and we have a week before it expires, so we're doing pretty good. So that all being said, I'm going to go. We're going to delete the lines on the chart, and we're going to jump into the daily, and we're going to take a look and see what that is telling us. As of right now, you can see that we are kind of in a position where we have, going through our practice, our trend. Okay? Our trend is one now of, as of right now, it's still lower highs and lower lows. Okay? And so you're really in a real complicated place as far as trend goes on this chart. You can see that your bias, however, is to the long side in the upwards direction. And so this still can be proven to create a higher low here into a higher high. It hasn't yet, but it could. Again, this is a really good reason why playing a strangle or a straddle on this is really profitable at this point, is because you really can't tell entirely. You can tell your momentum is down, but you're turning back up. It's starting to turn over just a little bit. So there is you are getting this sort of divergence right here. It's not quite divergence. It's more just a shift in momentum back in the upwards direction. I expect that to continue into CPI report. CPI is really going to be everything. What I really expect this market to do, though, is hinge around this 18-day moving average. Now, tomorrow, you are a little bit above the 18-day moving average here. Tomorrow is what they call Turnaround Tuesday. Typically, whatever direction the market's been going the last couple of days, it turns and goes the other direction on Tuesday. And a lot of times, because Wednesday is bigger reports and stuff, and it tends to, whatever it does, when these big reports come out, and you can go back and look on the chart through all of this, pretty much every major report, you went back to the 18-day moving average. You can go all the way back up here where Jackson Hole event was and see where, hey, we're rallying up, and still it stopped on a dime and turned and came back to the 18-day moving average before it made its final decision. It came down to it. It will go up to it. Okay, so the thing is that, again, coming into CPI report, we're going to see this move back to the 18-day moving average. That's its home base. It may go back to the 18-week moving average. I'm not going to go over that chart. We went over that this weekend. The price on that's sitting right around 384. So it may go back to 384, the weekly moving average, 18-week moving average. But one of those 18s, either the daily or the weekly, is going to be kind of where your home base is for this, into all of this sort of, till we get some of the election announcements, till we get some of the, until we get the CPI data and some of those other things, some stuff that's going to paint a picture as to kind of the direction that the Fed is going to be moving in, the direction that taxes are going to be moving in, those things. We're really going to be kind of sitting here at home base. As you can see, we are a bit above that 18-day moving average. I would expect to see a pullback into it tomorrow. I'm hoping to see some type of support. If we do rally up, if we do continue rallying up, look for this right here to get to the upper Bollinger Band as far as where I think the bulls will try and push this to. And then really, that will probably, again, we're probably going back to this 18-day moving average just into CPI no matter what. So you might have had your little bit of a pop, your election day pop here. Tomorrow, I'd probably see some pulling back right into this mean. And then, so that's what I'd be saying. To be honest with you, if you wake up in the morning, if I wake up in, I really shouldn't be telling you what to do, but if I wake up in the morning and this is gapped up, I'm going to be looking for puts. Okay, that's just the way I'm going to be. Now, I will be wrong if it continues to go up, but if we do get the gap up in the morning, I will definitely be really looking at puts and looking at reasons to buy puts and places to buy puts. Again, it's a question of rumor versus news. Buy the rumor, sell the news, or sell the rumor, buy the news. That's kind of where I sit with it. So I'm going to go over one more thing with you guys. We're going to go look at the VIX because it's lining up on something that I set up a few weeks ago that I think that's really, really interesting. This is something that I've seen and that I drew, and I adjusted the lines a little bit this morning, but not really moving them a whole bunch. This is a monster breakout setup that I think is forming into what we could be getting as our actual crash, okay? And what I want you to see is we had this trend line going up, okay? You had this thing going up here. And we came back and we broke the trend, okay? Now, just like on SPY, where, again, you can see, you saw SPY trying to get back. It's making a move back in the direction towards that trend. That's a typical breakout setup, okay? There's a point where they run it up, they build this wedge. See how it sort of hits against this a couple of times, but into sort of a wedge thing? Then you get one of these monster pullbacks. And one of the things I think is really interesting about this is how much, so if you draw across these first two peaks in this thing and draw it down here, how it's kind of following that same sort of line all the way down. Again, I'm not too certain that this is not setting up just a monster move in the upward direction, right? Going right and it will be pretty parabolic at the point it happens. Again, it seems too clean for it not to be something. It could not be something. It may not be. Now, it will if we get really far below this line right here, right? If we break out of this zone to the downside, then this is all of your higher lows from this previous run up have been canceled out, and so that won't be happening. But again, I'm definitely keeping an eye on this to see a turn back in the other direction as far as volatility goes, especially as the Fed continues to unwind its balance sheet and we see issues with liquidity. Anyway, that's going to do it for me today. Thanks, guys, for watching. Do me a favor on your way out, hit the like and subscribe button. It really helps the channel. If there's any questions or anything you want to know about me or this thing, go ahead and ask comments in the comment section. The Russell Journal is written, edited, and hosted by me, Russell Liss. We are produced by Social Media Shows. Our executive producer is Maria Pereza. Please check out Social Media Shows if you'd like to put on a show like this. They can help you out a lot. And until tomorrow, pretend I said some sort of catchphrase.